Day. And today we're going through the pre-December 2025 MOOC for tax, the UK variant, the debrief. And I'm going through the section C questions, starting with the first question that was about jazz. So as usual, remember, before reading the question, read the requirement so that by the time you are reading the question, you already have in mind what to look out for, okay? So on the required side, we've been told that for each of the two alternative ways of jazz making a pension contribution of £25,000, company pension scheme or additional director's remuneration, and then jazz personally making a personal pension contribution, calculate the revised figures for each of the four tax and NIC figures already calculated for the year ending 5th April 2025. We've been told in the notes that under the additional director's remuneration and personal pension contribution alternative, you are expected to produce a full income tax and employee class 1 NIC computation. And if applicable, you should state if any of the four tax and NIC figures already calculated remain unchanged. So the examiner has told you what he expects to see in your answer, okay? Make sure you follow that. So let's now read the scenario. You should assume that today's date is 1st March 2025. Jazz is the managing director of Malbec Limited and owns 100% of the shares. Malbec Limited has no other employees. So basically, this is Jazz's company, okay? But the company is, as written in the second paragraph, Jazz will receive gross director's remuneration of 35,000 and dividends of 70,000 from Malbec Limited for the tax year 24-25. And Jazz has no other income. So basically, the company is paying him a remuneration, which will be computed as employment income for Jazz. And we have the dividends as well. After adjusting for Jazz's remuneration of 35,000 and the associated employer's NIC, Malbec Limited has a forecast tax-adjusted trading profit of 290,000 for the year ended 5th April 2025. After adjusting for remuneration and NIC, what does that mean? Remember, from a company's perspective, whatever companies pay to employees as salary, remuneration, and employers' contribution into employee NICs, they are allowable deductions before in getting the trading profit, okay? So that's what they're saying, that before getting the 290, they've subtracted 35,000 and the associated NIC they made. Then, based on these figures, the tax and NIC for Jazz and Malbec Limited for the year ending 5th April 2025 will be as given. We've been given Jazz's income tax and employee class 1 NICs based on his director's remuneration of £35,000 and dividend income of £70,000. They've calculated these figures. So from Jazz as an individual, from his point of view, they've computed his income tax and class 1 NIC. And from the company perspective, they've computed Malbec Limited's corporation tax and employer class 1 NIC. Remember one thing, that employees class 1 NIC and employer class 1 NIC, the computation is based on the same figure, which is going to be the cash earnings of cash earnings and bonuses of the employees, plus any mileage allowances above the approved limits, okay? Then they've told us that Jazz has decided that he should start saving for his retirement. So he plans to make a gross pension contribution of 25,000 before the end of the tax year 24-25. And Jazz is considering two alternatives for that. The first is that Malbec will make a pension contribution to the company pension scheme. So the company will do an employer's contribution on Jazz's behalf into the scheme of 25,000. The second option is that Malbec will pay Jazz an additional gross remuneration of 25,000 for the tax year 24-25, and it will be Jazz who will make a personal pension contribution, gross amount of 25,000. So we're supposed to, this is basically a tax planning area, okay? We're supposed to consider the effect of these two alternatives. Is it, okay, they've not told us to advise, but they've simply told us that calculate the revised figures. If Jazz makes the contribution after getting an additional remuneration, or if the company directly makes the 25,000 into the pension scheme on his behalf. So, but it's a planning area, although they've not asked us to give any advice. They're basically, they've given us the figures before, like you can see here, and what will the income tax, NICs and corporation tax be if those two alternatives are considered. And like we already read, note number 1 says that under the additional director's remuneration and personal pension contribution alternative, you are expected to produce a full income tax and employee class 1 NIC computation. So they've told us the way they want our answer laid out, okay? So that's under alternative 2. And if applicable, you should state if any of the 4 tax and NIC figures already calculated remain unchanged. Now, if you look at alternative one, Malbec Limited making a pension contribution to the company pension scheme of 25,000. What happens in alternative one is that, is the company giving Jazz anything additional in forms of remuneration? No. His cash earnings are not changing. So once the cash earnings of the employee do not change, then what does not change? The income tax for Jazz will not change. The employer and employee class 1 NICs will not change as well, isn't it? Because they're based, like I already said, they're based on the cash earnings, bonuses, and mileage allowances above the excess. So for alternative one, it's quite an easy one. Jazz's income tax remains the same. Employee and employer class 1 NICs remain the same. Also, why does income tax remain the same? Income tax remains the same because although the company is making a pension contribution on his behalf to the company pension scheme, employer contributions in employee pension schemes are considered exempt incomes for employees, okay? That's the reason why Jazz's income tax is not going to change, because it's an exempt income. But from the company perspective, the corporation tax figure will definitely change. Why? Remember when we were reading through, I told you that the contributions that companies make into the into the pension schemes of employees, they are allowable deductions when computing the trading profit, okay? So this 25,000 is going to reduce this tax-adjusted trading profit of 290,000 that you see there. And once that reduces, obviously the corporation tax liability will also reduce. So let's start with the first alternative. Coming to our answer area here, alternative one. Alternative one is what? Company pension scheme. Company contribution and company pension scheme. In this alternative, the first thing we have to tell them is that Jazz's income tax, a single Z, Jazz's income tax will remain unchanged at pounds 25,375. And you have to say why? Because employer contributions in employee pension schemes are exempt income for employees. Okay, so you've mentioned and that's what point 2 said up there. If you see, if applicable, state if any of the 4 figures already calculated remain unchanged. So we had to mention that. You do get a mark for that, okay? Then the next thing we also need to tell them is that both employee and employer class 1 NIC will also remain unchanged as Jazz's earnings remain unchanged. Okay. And lastly, we need to mention that the corporation tax liability, Malbec's revised corporation tax liability will be, let's compute it here briefly. GBP, what was the first one? They said forecast tax adjusted trading profit is going to be 290,000 less contribution in pension scheme, in employee in the company pension scheme. That's going to be 25,000. So then we're going to have 290,000 minus 25,000 gives us 265,000. So corporation tax liability, this company does not have any associated companies. Malbec Limited does not have any associated companies, and this is a full 1-year period. So that means that, remember, your upper limits and lower limits, those are revised for 2 things, associated companies as well as shorter periods of account. In this case, neither is applicable. So if you look at the upper limit, it remains at 250,000, and this company's adjusted profits are 265,000. That means they're going to pay tax at the higher rate, 25%, okay? 25% times that. The revised corporation tax, let's put the word revised then. Revised corporation tax liability for the company is going to be 66,250. So that's your part A done. Simple and easy there. Not part A, technically alternative 1. There's no part A here. Okay. Now we move on to alternative 2. Alternative 2, it's also easy, it's just that it's slightly longer, okay? Alternative 2, we've been clearly told in note number 1 that we are required to produce a full income tax and class 1 NIC computation. So why are we required to produce one? Because in alternative 2, Malbec is paying an additional remuneration to Jazz. And that means that his employment income is going to increase. And when his employment income is going to increase, obviously, his income tax liability is going to change, his NIC will increase, and both employee class 1 and employer class 1 NIC will be affected as a result of that, okay? So let's start with his income tax computation is going to be, first of all, we put our NSI, non-savings income, simple things that we did in class in the first chapter, okay? Non-savings income, we have employment income. Oops. Employment income. Originally, he was earning how much? He was earning 35,000, right? Yes, 35,000. And they said that they are going to add him another 25,000. Okay, so his NSI is going to become 60,000. Dividends remain unchanged. Dividends remain unchanged at 70,000. So his total income stays 60 and 70. Okay, now at this point, you take a break. Remember what we said, that you need to go on the side and compute your adjusted net income. Whenever there's gross gifted donations and gross personal pension contributions, you are going to have a working for adjusted net income. And remember, if a person's personal allowance depends on their adjusted net income. So you come there on the side and you put there adjusted net income. Adjusted net income is going to be our total net income, which is going to be 60 plus 70,000. Why do I need to type it? I don't need to type it. I can simply cell reference. The advantage of using CBE, okay? The total net income is 130,000 less the gross PPC, gross personal pension contributions. So they're telling us that Jazz will make his personal pension contribution of 25,000 there. So 25,000. That means his ANI, adjusted net income, there's no gross GAD in this case. His ANI is going to be 130,000 minus 25,000 gives us ANI of 105,000. Now you're seeing that there, what does that strike us? That his ANI is above the limit of 100,000, okay? But it's below the higher limit of 125, 140. So that means there's going to be a reduction working for the ANI. How do we do the reduction working? You have to subtract the limit. The limit is 100,000. So 105 minus 100,000, whatever figure we get there, we need to divide by 2. So reduction in personal allowance will be the 5,000 over 2. And so reduced personal allowance is going to be, what's the normal personal allowance? 12,570 minus the reduction that we just computed. So his reduced personal allowance is 10,070. Now you go here, come back to our computation, less personal allowance. Simply pick the figure from there by cell referencing. And why? Remember, always subtract it from NSI first, and if there is any excess left, then you move on to savings or dividend income, okay? So this now gives us taxable income. Taxable income is going to be 60,000 minus 1070 is going to give us 49,930, and then this remains at 70,000. There's nothing we deducted there. Now, before we do our income tax computation, remember one thing, that we had gross PPC, right? So gross PPC, gross GAD, whenever that's there, our bands are going to be affected. Our bands are going to be affected, meaning we need to do band extension. So band extension, let's put that there, band extension. The first band is 37,700. To this, you're going to add what? Remember that we said that band extension for personal pension contributions is done with the TRC, the tax relief contributions, isn't it? And TRC is the lower of relevant earnings and gross PPC. The relevant earnings here in this case is the employment income of 60,000 and the gross PPC is 25,000. So the band extension has to be done with the 25,000, not the 60,000, okay? So the lower of. So what do? We add there plus 25,000 That gives us our revised band at 37,700 plus 25. Another way to do that, is simply that you go to that cell and then just do 37,700 plus 25,000. Okay, so that saves us time. That's okay. We can delete the rest of the working. Then the next, remember the higher band is 125, 140. And to that, we're going to extend it by 25,000. So that's the extended bands are standing at those figures. Now we can come and do our income tax computation. Sorry, let me delete that. Okay, has it gone? Yes, it has. Okay, no, it hasn't. It's there. So coming to our income tax liability, we start with non-savings income. We have, if you look at his non-savings income, it is 49,930. And if you look at his extended band, the basic band has capacity of 62,700. So it is more than enough to tax all that 49,930 at the lowest rate of 20%. 49,930 times 20% is going to be that times that. Okay. Then we move on to the next. We are now on dividend income. Dividend income. I'm going to put some space here so that we can reduce. Oh, where did it go? Yeah, okay, there we go. Dividend income. Remember, the first 500 of dividend income is taxed at the 0%, the nil rate band for dividend income, isn't it? So that times that is 0, obviously. So from the 49,930, we've already taxed 49,930. There's nothing left there. Now on the dividend income, we've taxed 500, but the 500, although it is at the nil rate band, it consumes our bands, okay? So from the 62,700, we've taken out 49,930, isn't it? Oh, what did I do? Here, 62,700, we've taken out the 49,930, and we've also taken out 500. We've also taken out 500. So what's the remaining capacity of this band? 62,700 minus 49,930 minus 500. The remaining capacity is 12,270. So 12,270 is going to be taxed at, what is the starting for dividend income? If you forget, you see tax tables here. Always go and have a look at that if you're unsure, if you've forgotten, okay? So times 8.75% is going to be 12,270 times 8.75. That gives us 1073.6. And lastly, so now what's left? Minus 12,270 is equal to negative 12,270. Okay, so what's left? Let's see what's left in the dividend income. We have 57,230. 57,230. If you look at the capacity of the higher band, it's more than enough. So we've exhausted the 12,270 there. Okay, so there's nothing left there now. So this second band, the capacity is more than enough to accommodate the 57,230. So the 57,230 is going to be at, what's the second rate for dividend income? It is 33.75%. And then since I put the formula up in that cell, if I simply drag this down, I'm going to get the computation automatically done there. So I don't need to rework that out, okay? So the total income, we call it revised income tax liability is going to be the sum of all those, the sum of all these figures that we just computed. Okay, so 33,775 is going to be his revised income tax liability. Then they've asked us to compute the NICs as well. So coming to the NIC, we'll do employee NIC first. So here, class 1 employee NIC. Class 1 employee NIC is based on the cash earnings and the bonuses and mileage allowances above the extra, both the class 1 employee as well as employer NICs. Now remember, this guy his earnings are 60,000, okay? So if you recall the NICs, if you don't, let's have a look at our tax table. You go here in case you're stuck, and it opened right on the NICs, good. So NIC for employees from £1 to 12,570 is at 0. And then above 12,570 to 5270 is at 8%, and then above 5270 is at 2%. So using that, we know that 12,570, not typing, 12,570 is going to be at 0%. Which is going to be 0, obviously. But let's put a formula so we can drag it. Okay, the next, the capacity. So 50, they said above 12,570, but less than 5270. If you do the difference there, it's 37,700. But just to confirm that for you, 50, what's the limit? 5270 minus 12,570. It's going to be 37,700. So that amount is at 8%. And the remaining, the excess above 5270, in this case, this guy's employment income is 60,000, isn't it? So you pick the 60,000 minus 5270. The excess is 9730, that's going to be at 2%. Now, since we have put a formula there, all I'm going to do is drag that down so that I don't have to retype the formula again. And then the total class 1 employee NIC is then going to be 3,210.6. Then we move on to class 1 employer NIC. Class 1 employer NIC, let's have a look at the rates in our tax tables. Class 1 employer NIC is up to 9,100 per year is at 0. 9,100 above that amount is at 13.8%. And employment allowance is £5,000. Now, this guy is not going to be eligible for employment allowance, remember, because he's the owner and he's the sole employee of the company. So he is not eligible under the rules for employment allowance. So we ignore that. And we've been told that above 9,100 is at a flat rate of 13.8. So there's a shorter way we can do it here. They've already calculated the employer class 1 NIC for us. Based on his original earnings of 35,000, his class 1 employer NIC was 3574. Now that 35,000 would have already consumed the 9,100 band, isn't it? So there is no exempt income. The additional 25,000 is going to be all at a flat rate of 13.1%. So original NIC is, where have we gone? Original NIC as per question is 3,574. To this, we're simply going to add additional NIC is going to be his additional, what he gets in excess. Okay, so he's going to be getting 25,000 more to put in his pension scheme, and that's going to be at a rate of 13.8%. So there, you just then get the sum of those two figures. And that's going to be the revised class 1 employer NIC. Okay, let's put this description here for them. Revised class 1 employee NIC. How about that? Okay, so we're done with his income tax computation. We're done with the class 1 employee and employer NIC. So the last thing we have left is the corporation tax liability, isn't it? So the revised corporation tax liability. The original figure, the tax adjusted trading profit, was given to us at 290,000. But remember, when the employer pays additional remuneration and NICs, that means that's an allowable deduction. So less the incremental, the additional salary remuneration, you can call it, was 25,000, and less the additional employer NIC, which we computed in our working at 7024. No, that's not the incremental, that's the total, isn't it? The incremental was 3450. So what is the revised TTP? Is going to be 290,000 minus 25,000 minus 3450 gives us 261,550. So revised corporation tax liability is going to be, again, this is above the upper limit of 250,000. So that times, it's going to be at the rate of 25%. So 65,387 0.5 or 388 if you round up, it's going to be the revised corporation tax liability. And that is your question done for 10 marks. Okay, not difficult if you know the rules. So that was Jazz Limited. Now let's move on to the next question. The next question is going to be, we go to our navigator. Oh, okay. So we're now on Anya. The question of Anya says, calculate Anya's taxable income for the tax year 24-25. And they've told us that you should indicate by the use of 0 any items which are not taxable or deductible. And that's for 11 marks. So this is the first part of the requirement. There should be an additional, when you click next, you'll get the next part of the question. So let's read and work out part A. We're looking out for Anya's taxable income, okay? So Anya is employed by Zenith, and she also has some trading profits and property income. The following information is available for the tax year 24-25. With employment with Zenith, Anya received a gross annual salary of 70,000. Okay. From 1st October 2024, Zenith provided Anya with living accommodation. The company purchased the property in 2010 for 100,000. Its market value on 1st October 2024 was 250,000. So what do you notice here? First of all, they gave her this accommodation in between the tax year, okay? So usage benefit is not going to be for the entire 12 months. It's only going to be from October to, when does the year end? This is which tax year? 25. So it's going to be from October to April 2025, which is how many months? If you count October, November, December, January, February, March. So those are 6 months, okay, because it's beginning of April, so you don't compute that. So 6 months. But again, notice the dates. They said the company purchased the property in 2010 and they gave it to Anya on October 2024. So is that more than 6 years from the date of purchase and the date that they've made it available for employee use? Yes, it's definitely more than 6 years. So remember, you don't use cost, you use the market value for assessment. And obviously, you can clearly see that the value of this property is above 75,000. So aside of the basic accommodation benefit, Anya is going to be taxed on the additional accommodation benefit as well, isn't it? Then they told us that the annual value of the property is 6,700 and the living accommodation is not job related. So because it's not job related, obviously, there is going to be an accommodation benefit taxed on her. Then they've told us that Zenith purchased furniture for the living accommodation during August 2024 at a cost of 14,000. And Anya paid a professional subscription of 280,000 and a subscription to a health club of 650,000. Neither of these subscriptions were reimbursed by Zenith. Professional subscriptions, remember, you're allowed to subtract that. That's an allowable deduction in the computation of employment income. But subscription to health clubs are not allowed, okay? And neither of those subscriptions were reimbursed. So we'll be allowed to deduct the 280 regardless of the fact that the employer did not reimburse it, but we're not going to be able to reduce her employment income by the 650. Then they said professional subscription was to an HMRC approved professional body directly related to her employment duties, and she uses the health club to meet clients of Zenith. So regardless of the fact that she uses it to meet clients of Zenith, it doesn't matter, okay? It doesn't matter. It's not an allowable deduction. Then they've told us that they've given us information about her self-employment and they've given us information about property income. So since we're going to calculate her taxable income, we can start by working out her employment income and then we will move on and read the rest as we go along, okay? Okay, so Anya, we put our heading there, coming to our answer area. Anya, taxable for 24-25. Employment income, so let's put GBP. Employment income. It's obviously going to be a working, so we tell the examiner that please look at our working one. And then we have to come on the side and we put a heading, working one, employment income. Okay, so the employment income, obviously the first thing she's getting there is her salary. We've been told that she gets how much as salary? She gets a gross annual salary of 70,000. Since this is a full year, so we're going to put the entire 70,000. Be careful if it was a mid-year employment. it would have to be prorated then. Then the next note, number 2, was accommodation benefit. Okay, but we're going to have two benefits there. So the basic benefit is going to be the annual value is given to us, but the problem is, this is not really a problem, but this property was not available for the entire year. It was only given to her from October, so she's only going to be assessed on it from October to April, not the whole of April. So technically October to end of March. So if you count those are 6 months like we already counted, isn't it? So times 6/12 is her basic benefit. Let's put that in the working middle column. Okay, so we can total that. Okay, then additional benefit. Additional benefit is going to be the cost, not the cost, because it's greater than 6 years. We agreed that we take market value when it's above 6 years. So 250,000 minus the limit of 75,000. And then what's the amount that they charge for additional benefit? Remember, it's at 2.25% per annum. So times, again, if you forget, that is in the tax tables. Okay, so times 2.25%, but that's 2.25 per annum. Did we have it for the whole year? No. So times 6/12. And that gives you, where is my additional benefit? That gives you additional benefit that has disappeared. Oh no, looks like we have to type it again. Okay, is equal to 250. Why am I putting a comma? Comma is not required. 250,000 minus 75,000. Okay, times 2.25% times 6/12. Oh, it appeared finally. So 1968 is going to be her additional benefit. And then what else? That's it for accommodation benefits. Simply get the total and put it there, is equal to 3350 plus 1968. Okay, that's going to be her accommodation benefit. Then the next benefit, note number 3, said Zenith purchased furniture for the living accommodation during August 2024 at a cost of 14,000. So usage benefit, furniture usage benefit is going to be, usage benefit is going to be how much? 14,000. Remember, whenever the employer provides anything, any of his stuff to use in the house, it is going to be at a rate of 20%. But again, that's how many months? It's August, September, October, November, December. Oh, no. What happens is that Zenith purchased, now be careful here. They told us that Zenith purchased furniture for the living accommodation during August 2024 at a cost of 14. So although they purchased this furniture in August, when did they give her this accommodation from? They gave her the accommodation from October, isn't it? So is it okay for us to start computing the usage benefit even before she was using the furniture? Absolutely not, isn't it? So that August 2024 is a confuser there, okay? The furniture was in the accommodation. So that means that she is going to be taxed on the usage benefit from the date she occupied the accommodation, which again was October. So that's 6 months out of 12. So be careful of the petty things, okay? Oh, I need to put an equal sign there in our formula. Is equal to that. Let's push that formula out. Or let's simply get the total. No, let's put it out. It's okay. Okay, so that's furniture usage benefit. Then note number 4 says that Anya paid professional subscription of 280 and subscription to Health Club of 650. So we're allowed, like I told you, remember, we're allowed less professional subscription. We're allowed to subtract professional subscription fees, which was 280. But the Health Club subscription is not allowed. And this said indicate by the use of 0. Sorry, so we put the 0 there for the examiner, and then we can finally compute her employment income. Employment income is going to be, since I've not put negative signs, I'm going to do this manually, because if I put negative signs, it can lead to a bit of confusion, okay? So I prefer to do it manually to be on the safer side. So from the salary, we add the accommodation benefit, that's going to be taxable, it's going to increase her employment income. Then the furniture is also going to increase it, but the professional subscription is going to reduce her taxable income because it's a deduction. So 76,439 is her employment income. We come to our pro forma, our main pro forma, and then we So they put their equal to sign and pick that figure 76,439. Okay. Then moving on to the next part of self-employment. In self-employment, they told us that in addition to her employment, Anya started a business selling craft products. She spent $750 on advertising in March 2024, which included £100 spent on lunches for potential suppliers, and then began trading as a sole trader from 1st June 2024. Anya purchased, okay, so they've told us that her actual date on which she began trading was 1st June, but she incurred the $750 on advertising and $100 spent on lunch for potential suppliers in March. Okay, that was before she began trading. So we are allowed certain pre-trading expenditures. Remember, you're allowed to subtract. So we're going to be allowed to subtract £750 since that was just in March 2024. However, the money that you spend on suppliers, that is not an allowable, anything entertaining third parties is not an allowable expense, okay? So keeping that in mind while we compute her self-employment income. The other thing they told us is that she purchased a car on 15th June 2024 for £11,500, which she uses 60% for business purposes. The car has CO2 emissions of 47 grams per kilometer. And during the tax year, she drove a total of 23,000 miles in these cars and incurred motor expenses of 2,300. She decided to claim the flat rate mileage allowance in respect of the car. So she's not going to use the actual motor expenses of 2,300 plus capital allowances. Remember that when an employee opts for flat rate, you either do flat rate or you do actual expenses plus capital allowances. So we're going to ignore that, and we're going to use the flat rate mileage allowance. And then they told us that in the 10 months from June, when she began trading, to March, Anya made total cash sales of 9,750. So let's come back to our answer. Trading profits. We tell the examiner to go and look at our working two. Okay, so what's our working two going to be? Working two, trading profit. She had cash sales. Cash sales were 9,750. And then she spent the 750 on advertising. We're going to we call it pre-trading expenditure, less pre-trading expenditure, advertising. We're allowed to subtract that amount of 750. However, less pre-trading, third-party entertainment or supplier lunch. Zero, not allowed, okay? But we have to put there zero, so the examiner knows that we know the rule. And then the car, coming to the car, first of all, the motor expenses, they've told us, motor expenses, we're going to put there zero because although they've told us 2,300, we know that she's using approved mileage allowance, so she cannot claim that motor expense. So that means that she can claim approved mileage allowance, AMA deduction. That's going to be a bit of a working, so that's why I put that heading there. Now, in total, she drove 23,000 miles. But what are the business miles? So total business miles, remember, they told us that out of the 23,000 miles she drove, 60% were for business purpose. So that's the only one we can compute the approved mileage allowance on. So the first 10,000 miles at 45 pence, which is the same as $0.45, and the excess 13,800 minus 10,000, the excess is at 25 pence. Oh, sorry. Again, if you forget these limits, they're given to you in your tax tables. So if you forget, you can refer to your tax tables, okay? So that's going to be is equal to that times that, and I'm going to drag my formula down. So the total AMA deduction is going to be is equal to 45 plus 950. Okay, so 5,450 is her approved mileage allowance, and that's it for her self-employment. So what we do, we simply get the total there. Okay, so total trading income is going to be, let's put our equal to sign, her cash sales minus 750 minus 5450. Again, if you're comfortable putting the negative signs and you'll not mess up in your final formula, feel free to use the negative signs, okay? Okay, so we go to our working there. Trading profits. We put the equal to sign and pick out our final answer that we got from there. And that's it. Then the next, coming now to property income. They've told us that Anya rents out a furnished room in her main residence. She received a monthly rent of £800 throughout the tax year 24-25 and paid expenses of £275 a month in relation to the room that was rented out. Anya always uses the most beneficial basis to calculate her taxable property income. Remember, for when you have a main residence and you give out a furnished room in that, and it's occupied, partly occupied by you, and you've rented out a room, which is a furnished room, then you are eligible for what we call rent a room relief, which means that you are allowed to subtract a flat 7,500 off as expenses. So ignore your actual expenses and subtract 7,500, provided it's beneficial. If your actual expenses are higher, then you can obviously subtract your actual expenses. So if let's put here the property income. That's going to be working 3, and we go to our working 3 here on the side. Working 3, property income. Okay, so rent received, that's going to be how much? I should put that up. Okay, rent received, they've told us that she receives how much rent? She receives a monthly rent of 800. So is equal to 800 times, did she start her property business at the start of the year? I said, yes, she received that throughout the tax year, so times 12 months, okay? So rent is 9,600 less, if you look at, now I'm just going to do this, I'm going to do this to show you that which one is more beneficial, or you could do it on the side on your calculators. But if she does her actual expenses, look at this. Her actual expenses were how much? 275 a month times 12. What figure do you see there? 3,300. And if she uses the rent a room relief, she gets 7,500, isn't it? So it's obviously more beneficial for her to use rent a room relief because that will reduce her taxable property income. So 7,500. So here we're going to put there a 0, okay? And you get half a mark for showing that you're not subtracting the actual expenses. So put it there for the examiner. So her total property income is going to be 9,600 minus 7,500. So 2,100, simple working there, we go and put that in our cell, is equal to, pick that figure out, equal to 2,100. Okay, now we've done all our workings, and all we have to do is, because the question has asked us what, compute her taxable income. So we get the total income is going to be the sum of all that we've calculated. There is no other income she's earning, and her total income, net income, is under her adjusted debt. There's no gross PPC, there's no gross GAD. They've told us nothing about that. So that means that she's eligible for the entire personal allowance, less her personal allowance. Taxable income is always after personal allowance, okay? It's 12,570. That gives us taxable income of 82,089 minus 12,570. So her taxable income is 69,519, isn't it? 82, no. Is it? There's a slight error I noticed here. Look, in coming back to trading profit, there's a small mistake I made on trading profit. Okay, the trading profit here, they told us that the advertising, she spent 750 on advertising, which included £100 spent on lunches. So this 750 includes £100. Okay, so what I'm going to do is that I'm going to remove this line. No, I'll just put this, I'll make this 650 because the advertising minus the supplier lunch, basically I'm taking out the 100 from there. So that makes it 650. Has that changed our figures? Yes. So because I realized my mistake and everything was based on formulas, you can see that my taxable income automatically adjusted. Okay, so your taxable income is going to be 69,619, and that is your requirement done. How many marks was that? 11 free marks. Not really free, because quite a bit of work, but not hard work, right? Okay, so we move on to the next part. The next part is asking us that calculate the amount of income tax that Anya saved for the tax year 24-25 by choosing to claim the flat rate mileage allowance instead of capital allowances. So remember that relates to this note number 3 under her self-employment income, okay? Because they've said that she used the flat rate mileage allowance. So they're asking you that if she used capital allowances, that when you use capital allowances, you get capital allowances plus the actual motoring expenses, okay? So if she used that compared to the flat rate, now they're saying calculate the amount of tax saved. That means obviously the flat rate saved her more money. So they're asking us how much it would have saved her. That's for your 4 marks. So if she claimed capital allowances, how would the capital allowances be worked out? She's purchased the car on 15 June 2024. The date does not matter because the written down allowances are going to be given regardless of when it was purchased, as long as the accounting period for which you're computing is 1 year. Okay? In this case, we are computing taxes for the 12-month period ended April 2025. So she purchased the car for 11,500, which she used 60% for business purpose, and the CO2 emissions are 47. 47 means less than 50 grams per kilometer. This is a main pool item. But because there is private use, 60% business use, 40% private use, that means that this is going to be depooled, isn't it? It's going to be depooled. No, also, I told you that, yeah, she purchased the car when? She purchased the car on 15th June 2024, but then look at her trading period. Her trading period is not exactly 1 year because she started self-employment on 1st June 2024, and we're doing the computation till the end of the tax year, 6th April. So that means this is a shorter period, okay? We are going to have to prorate the allowances. So June to technically the end of March, they've already told us it is a 10-month period. Okay, so we are going to have to reduce her allowances. So what happens in this case is that she's going to get on the value of the car. Let's put there depooled asset, private use car, and we put our allowances column there. Where is that? Okay, so how much is the value? What is the value of the car? It was, where is the figure gone? 11,500. Then she gets WDA at the rate of 18%, right? Because this is less than 50 grams. So is equal to 18% times 11,500. But remember, this is for a 10-month period. So times 10 out of 12. That gives us 1725. But in the allowance column, are we allowed to take 1725? No. We are only allowed to take the business use. You don't need to put this there. I'm just showing you because this is how we did it in class. So just as a recap, but what you can do directly is that in the allowance column, you multiply 1725 times the business use percentage. I'm supposed to put here, sorry. The business use percentage is 60%. So allowance is going to be 60% times that. So you would directly just put the formula there, okay? And that would be fine. Now that's not the only thing. Then she would get motor expenses. They said the motor expenses she incurred were 2,300. So 2,300, but 60% is business use. So that's the only amount she's eligible for. So total allowable deduction is going to be 1035 plus 1380. So if she claimed capital allowances, her total allowable deduction would have been 2415. But deduction under approved mileage allowance, let's go back. How much did we deduct? Okay, they're saying we need to complete the spreadsheet. So they're wanting me to scroll down, okay? So I go previous question. Please finish the spreadsheet entry. Okay, let's use this navigator. 33, no, it's not going to work, hold on. under the approved mileage allowance, we had claimed a deduction of how much? 5,450, isn't it? So let's go back. 5,450. So the additional, saving as a result of using approved mileage allowance is going to be is equal to 5,450 minus 2,415, and then you're going to save 3,035. But they asked us what is the income tax going to be saved. So we already know from our previous computation that she's going to be a higher rate taxpayer, because remember her level of earnings were 80-something thousand, right? So she's going to be paying tax at the rate of 40%. This is all part of non-savings income. So income tax saved at higher rate percent is equal to 40% times that amount. So she saved £1,214 as a result of using approved mileage allowances. That's your 4 marks there, and that's this question done. Okay. Going to the next question. We are now on the question of, what is this? Apex Limited. Apex Limited has told us, Part A says, prepare a revised corporation tax computation for Apex Limited for the year ended March 2025. You should indicate by the use of 0 as usual any items in the computation of trading profit for which no adjustment is required, and that's 12 marks, okay? So coming to the scenario, you're a trainee chartered certified accountant, and your manager has asked you to review the draft corporation tax computation prepared by the finance director of Apex for the year ended March 2025. The finance director is new to the role and has made several errors. So they've given us the computation, trading profit. They said refer to working one for it. Dividends received from 30% shareholding in UK company and taxable profits are 177,114. Corporation tax, the first thing you notice is these guys have applied the tax rate on augmented profits. Okay, first of all, that's not the taxable profit, that's augmented profit. So if you recall, corporation tax computation, the tax is not applied on augmented profits. Augmented profits are simply for establishing the rate of tax. You then have to multiply that by your taxable profits, which is not 177, because you would not be adding the dividend there, okay? Then they've given us workings, whatever they've used to compute that 174 figure, they've given us the details of that. And they've said that in addition to the legal fees, a premium of 24,000 was paid on the acquisition of a new 6-year lease on an office building that was used in trade from 1st Jan 2025. And that the year end, remember the year end is March 2025. So there's a premium on lease of 24,000. The lease premium has not been included in the operating profit figure or the calculation of trading profit. So we're supposed to do an adjustment. Lease premium there is an allowable deduction for lease premium, but you have to do the computation, okay? Then there's capital allowances. Capital allowances, if we have a glance at it, they've given us tax written down values of the different things. Then additions, they've given us new office building integral features, a new car for finance director. Note 1 and note 2. Now, if we read the notes, they've told us that note 1 says new office building integral features were acquired and brought into use on 1st July 2024. Okay. Now, if we see new office building integral features, they have directly put this in the pool. Remember, this thing is eligible for AIA, annual investment allowance, isn't it? There's no need to put it in a pool. It would all be eligible for AIA. And secondly, note number 2 says that the car has CO2 emissions of 55 grams per kilometer. That means this would be a special rate pool item. It was purchased for use by the finance director, and 20% of the mileage is for private journeys. And if you see, these guys have depooled it and called it a private use car. But what's the rule? That private use by employees is not considered private use. It's only private use by the owner, which is considered private use, isn't it? So this was supposed to go in the special rate pool, not depooled as they've done it. And they've depooled and given it what allowance? Oh, they've given it an allowance of 18%. Why have they given it an allowance of 18%? That's not the right allowance they're supposed to calculate, isn't it? So let's go and rework this out. this wrong computation. So prepare a revised corporation tax computation. We come to our cell here. We're going to write the company name, Apex Limited, revised corporation tax computation for the year ended 31st March 2025. The first thing we start with is the trading profit, isn't it? Yes, trading profit. Trading profit is going to be a working, obviously. Working one. Come to the side, put that working one, trading profit. Okay, and put your symbol there. So we start with what they've given us. Look at the workings provided. We were told that operating profit was 137,000. Depreciation, as you can see, all these items have been added back. Okay, so this guy, the finance director, added back depreciation. He was right, because depreciation is not an allowed deduction, but instead you get capital allowances, isn't it? So that stays, you add back 20,000. Donation to national charities. Donations are not allowed except if it's to a local charity. So we add back the 1,000. Then professional fees. Professional fees for general accountancy, those are allowed, isn't it? Professional fees are an allowable deduction. So you put there 0. There's no, we're not going to make any, we're not going to have to add that back. This guy has added it back to increase the operating profit, but we're not supposed to, okay? Because it's an allowable deduction. We don't need to increase our operating profit by professional fees. Then legal fees on the acquisition of a new lease. You're only allowed legal fees on renewal of a short lease, not on acquisition of a new lease, okay? So legal fees, he's added that back, which is fine. He was supposed to add it back, okay? So we also add back the 4,000 because that increases our profits. If it was legal fees on the renewal of a short lease, that would be allowed. But then they directed us to the note where we read that there was a premium, there was a lease premium, which they did not deduct, isn't it? So we're supposed to deduct that lease premium here. That's the note. In addition to the legal fees, there was a premium. So deduction for lease premium. How much is it? Remember, the formula is that we get the amount assessable on the landlord and then divide it by the useful life of the lease. And obviously, we need to consider the months, okay? So first of all, how much is the amount assessable on the landlord? The formula would be amount assessable on landlord. The formula is the lease amount, 24,000, minus 24,000 times 2% times n minus 1. N minus 1 is going to be your, what the n is the useful life of the lease, so 6 minus 1. Be careful with the brackets. If you're not very confident on a big formula there, then do not put it all in one cell, okay? Break it down, or first confirm it in your calculator, because if you do your brackets wrong, you will mess up. So amount assessable on the landlord is 21,600. So the deduction we are allowed is going to be 21,600 divided by the useful life of the lease. In fact, let's directly put this in this lease premium deduction is equal to 21,600 divided by the useful life of the lease is how much? 6 years, we are told, isn't it? But remember, when did we enter into the lease? They said that the building that was used in trade from 1st Jan 2025. So January, February, March, 3 months only, isn't it? So times 3/12. That gives us the the deductible amount as 900. And then after that, we move on, entertainment of suppliers. Third-party entertainment, not allowed, so we have to add that back to increase our taxable profits. Client entertainment, not allowed. Don't confuse this with VAT, okay? Although they've told us these are overseas clients. Those were VAT rules are different from the trading income rules. So we have to add back the 2,500 as well. Star Christmas party. Employee entertainment is an allowable expense. So we don't need to add that back. This director has added the 1,800 and increasing the profit, but no, that's not supposed to increase our taxable profit. It is an allowable deduction. And then capital allowances. We're going to have to do a working for this. So we'll reference it as working 2 because this guy messed up on the workings. We need to recompute the capital allowances, okay? So leave some space there and put their working 2, capital allowance. We'll do our pools. We have the main pool. We have the special rate pool. There's no need for the private use pool, isn't it? And then we have the allowance. If you go to the capital allowance working, tax return down value brought forward, TDWDV brought forward. In the main pool, how much was it? 15,300. In the special rate pool, was there a value brought forward? No. Then they've told us, I'm going to have to add a column. Let's push this. Pushed it too much. Okay, yeah, there we go. We have our column. Okay, because I need an extra column for the AIA, isn't it? Okay, so starting with the additions for new office building integral features. The value there was, if you see, they put it in the special rate pool at 17,500, but then this qualifies for AIA 17,500. Okay, so directly put the entire 17,500 in the allowance column. Then the next thing they purchased was the car, isn't it? And they said that new car for finance director, they've put it in the private use, but that's not supposed to go in private use. It's supposed to go in the special rate pool because of the CO2 emissions exceeding 50, right? So car, in our special rate pool, we're going to put it there as how much? How much is the car worth? 35,000. You see, they put it in the private use. So 35,000 there. Okay. Now, that's it. There were no other additions or disposals. So we simply calculate our written down allowances. Written down allowances on the balance in the main pool is going to be at 15,300 times 18%. That gives us 2,754. We put that in our allowance column so we don't forget it. Then the special rate pool, the car is going to be written down. Let's put this at 18%. Then written down allowances at what percent? Special rate pool gets at 6%, isn't it? So at 6%, you're going to have there is equal to 35,000 times 6%. That gives you an allowance of 2,100. So go put that in your pool, in your, allowance column. And that's it for allowances. We simply get the sum of these figures. The sum of these figures gives us the allowance at 22,354. So go back to your working up and put there the equal sign, pick out the allowance 22,354. So that's your capital allowances done. And that means that we are now having all the figures, the adjusted figures. So what we do is equal to, again, because I've not put the negative signs, I'm going to have to go the longer way, but I'm just doing this because this is at least the accurate way. If you put negative signs or you forget to put, this is a way for you to double check what is added, what is subtracted. So that all those things are added back. Donation to national charity is not allowed. Legal fees on the starting of a new lease is not allowed. Then the lease premium is a deduction, okay? So minus 900. Then again, 500 is allowed. Entertainment of supplier, client entertainment, not allowed. And capital allowances are allowed. So when you do that, you get your final figure as 141,746. At least you're accurate. You know what is added, what is subtracted. If you're very confident on the negative signs is when you put them. Otherwise, don't mess your formula. Okay, so we're done with, this is the total, this is the revised trading profit. So I'm simply going to go to my trading profit and I'm going to pick that figure out from there, okay? I'll pick it. What's our revised trading profit? 141, 746. Then, of course, we've been given, is there any, let's read what he subtracted up again. Okay, he subtracted the dividends, the 30% dividend, and then donation. Okay. Any other thing? No. Now, donations to national charities, okay, they are not allowed in the subtraction of trading profit. But remember, these are qualifying charitable donations. So although we added it back in that working for trading profit, when we have our total income, oh God, sorry, this became so big. We are allowed to subtract QIPs from there, isn't it? So that donation to national charity becomes a qualifying charitable donation. So less qualifying charitable donations, we're allowed to subtract 1,000. The 1,000 is basically that donation to national charity, okay? So that gives us our taxable total profits, TTP of that minus that. Then less, no, dividends. To this, there's non-group dividends. So add non-group dividends. How do I know this is not a group company? Look, it's a 30% holding. Okay, so it's not a group company. Non-group dividends is going to be 2250 to give us augmented profits of 142,996. And now you do your corporation tax liability. 142,996, this is an entire year, and there are no associated companies. So our lower limits, upper limits are not revised for anything. They stay at 50 and 250. And since the augmented profit there is 142,996, that means we are in the marginal category. Okay, so 25% minus marginal relief. So that's going to be the TTP of is equal to 140,746 times 25%. Okay, and then marginal relief, less marginal relief. Marginal relief, what's the formula? It's quite a bit of a formula. So if you're not confident, you can simply type out the formula, work it out in your calculator, and then put the figure there. Okay, if you're not confident with the brackets. But the formula is the upper limit, 250,000, minus your augmented profits, okay, times the standard fraction of 3 out of 200 times what? It's going to be times TTP divided by augmented profits. That divide by that. Okay, so are our brackets set? Yes. So 1579.8 is the marginal relief. So final corporation tax payable is going to be the 35,187 minus the marginal relief of 1579.8, which gives you your corporation tax as 33,607. And that's your answer there, done for 12 marks, okay? So now we move on to the next requirement. The next requirement has asked us that advise the finance director of the following. The due date for submission of the corporation tax return for the year ended March 2025. Remember, the due date must be filed within 12 months of the end of the accounting period. So requirement 1, part B, 1. The corporation tax return must be filed by 12 months from the end of the accounting period to which it relates, isn't it? So the accounting period relates to the year ended 31st March 2025. So 12 months from that date is 31st March 2026. Part 2 says, advise the director of the deadline for Apex Limited to amend this corporation tax return after filing. Amendment to the corporation tax returns are within 12 months of the filing due date, okay? So that means that Apex can amend this return by 12 months within the 12 months, 12 months with, sorry, my English, within 12 months of the due filing date. Due filing date of 31st March 2026. Thus, the date for amend the ABACUS can amend its return by 31st March 2027. Okay. And then lastly, the deadline for HMRC to give notice of a compliance check into this return, assuming that the return is not submitted late, okay? So when the returns are submitted earlier and on time, that means HMRC has within 12 months of the actual filing date of the return to give a notice of compliance check. So HMRC can issue the notice for the compliance check within 12 months of the actual delivery of the tax return. Okay. And that is your 15 marks there for corporation tax. And that's also the end of section C for this paper. Okay, so that brings us to the end of this video debrief. I hope we're comfortable with whatever has been covered, and all the best.